And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Direct indexing is attracting attention as a new form of investing. When you own an S&P 500 ETF, you have indirect ownership of the stocks in that index. You can't vote in shareholder meetings, nor can you buy or sell the underlying stocks. With direct indexing, you own the stocks in the index directly. You can customize it in any way you want. You can own Apple, but not own Exxon if you want. And you can do tax loss harvesting, selling the losers and using the loss to reduce your tax liability. Should you consider dumping your boring indexed fund, indexed ETF, and do direct indexing instead? Let's talk with Patrick O'Shaughnessy of O'Shaughnessy Asset Management, Dave Noddick, my old friend, Director of Research at ETF Trends. And Patrick, we always have to do an explainer on how this works here. You can slice and dice the S&P 500 essentially, or any other index, any way you want. So explain this briefly to us.
Well, I would just think 5 years ahead to the future. This is a technology trend. In 5 years, you're going to get to own a custom index that's built entirely for you. That could be customized on a lot of dimensions, as simple as the S&P 499, like you said, without Exxon, or it could be much more detailed, that you don't own stocks in the area that you work because you already have exposure there, that you don't own companies that emit fossil fuels, that you don't own certain other kinds of companies or overweight ones you prefer. There's lots of ways that we're seeing this platform get used, but fundamentally it is a technology trend, just like ETFs were, just like mutual funds were, as a better way for people to get access to the stock market.
Dave, this would make sense for a number of different things, but the one thing I think of is, for example, an ESG account, environmental, social, and governance account. You can essentially create, the Bob Pisani ETF that only contains my personal beliefs in ESG investing, for example. So talk to us about what direct investing lets you do here.
Yeah, I mean, you hit the nail right on the head, right? One of the big problems with ESG is it's so personal. I may care a lot about animal welfare. You may care about climate change. Not that we shouldn't care about all these things, but we may want to invest differently based on our beliefs. Very hard to do that with a big packaged product, even though we've had just tons of those types of products launched in the last year. In a direct indexing environment, you can literally move a slider around and say, hey, I really want to take carbon out of my portfolio. I don't care so much about tobacco stocks. That's not where I'm going to worry. So you really can create that socially conscious or environmentally conscious portfolio that's right for you, but is still based on fundamentally sound large cap indexing, for instance. That's really the advantage here, is you can choose what's important to you and capture a lot of those cost benefits and what we know are the long-term investment benefits of a fundamentally index-based approach.
Patrick, so again, this sounds terrific on the surface of it. Sounds like investors can now design their own ETFs, but what problem is it actually solving? I know you've talked often about the tax benefits. Is that the main advantage here? What am I getting by trying to get involved in developing essentially my own index?
Yeah, one of the advantages we have, given that we manage our own custom index platform called Canvas, is a huge number of accounts to see why people care. I think the question is a good one, like, great, you can customize, but what do you actually do with that? So we just have the data to show what people care about right now. 100% of taxable investors like the tax features. No one wants to pay more taxes than they need to. There's lots of ways you can do this. You could set absolute gains on how much tax you're willing to pay. You could set the index to say, give me as many losses as you possibly can so I can use those to reduce my tax bill elsewhere. But basically, everyone likes the tax benefits, and that should come to the mass market over the next 5 years. There's also things like ESG, but it's only about 20% of the assets on the platform as we see it today that make adjustments for things like carbon, or for even tiny things like they don't want to own companies that produce sugary drinks is one funny example that we've seen. But just 20%, but for those 20%, it's incredibly important. And then lots of things in between. Like I mentioned earlier, I don't want to own more capital market stock because my whole career is tied up in that space. If you work at Google, maybe you want less technology exposure and so on. I think the dimensions of customization will proliferate through R&D over the next 5 years, but clearly the demand is there for people to have their own strategy built just for them based on their circumstances and their preferences.
So, Dave, Patrick's been talking about tax loss harvesting as a main feature of this. Does tax management here really add any alpha? Can you show that people are doing better under it?
Yeah, absolutely. It can. There have been a number of studies on this, and obviously it depends a little bit on how much transactions might be in those types of portfolios. But there have been studies that show for somebody at the top end of the tax brackets, right, who's got potentially some short and long-term gains, you can eke a few extra % out a year by being really smart about how you manage those tax losses. As Patrick says, this isn't something that's just for the ultra wealthy. This is rapidly coming down towards the mass affluent market, and honestly will be in the mass market really very quickly. Schwab's developing product here. Fidelity's been developing product here. We've seen a lot of smaller direct indexing software providers get gobbled up by big ETF issuers. So I think it's a bit inevitable that we're going to get to this more customized way of approaching investments. It really is solving real problems for investors.
You know, Patrick, it seems like this could not exist without two things having happened recently. The rise of commission-free trading, frictionless trading almost, and fractional share stock investing, right? Doesn't that allow the investors to purchase these fractional shares in a certain dollar amount? Without these two things, how would you do this? It would get prohibitively expensive, wouldn't it? Or even impossible to buy the fractional shares, right?
Yeah, one of my favorite terms is directional arrows of progress from my friend Josh Wolf at Lux Capital. The idea that in technology, there are certain arrows of progress that are just sort of inevitable. We saw the march towards zero cost trading. We've seen the march towards fractional share opportunities, but also towards just falling operational costs on a per account basis that used to be shared by the ETF or the mutual fund. Now those costs can be very low for the individual. As you get lower and lower costs, lower frictions, that unlocks these big opportunities. So you're right, these things couldn't be possible without these trends in technology, but the trends are inexorable. They're going to keep happening and then some that enable this more custom way of investing in the future.
You know, Dave, I see sort of three things here. Number one, this makes most sense in a tax-managed account because of the tax loss harvesting, sort of less sense in a 401k, for example. Number two, this can get very complicated very quickly, a lot more complicated than most people want. And third, the expenses still can get away from you. Aren't you trading a lot potentially? I mean, you're becoming an active manager. I'm sorry to let my inner Jack Bogle out here, but isn't that an issue?
Well, it could be an issue if you constructed one of these things incredibly poorly, right? You can't put a 100% turnover strategy into a direct index and with a straight face call that indexing anymore. The idea here is to capture some of those great benefits of indexing, a lot of which have to do with minimizing that turnover in the first place. So it's really a balance between all of these competing things that you're trying to get out of your portfolio. Taxes aren't everything. You're right. This makes the most sense in a tax-aware account, a taxable account. But the other benefits we're talking about still matter. I've talked to several large investors who've used this to manage down large single stock positions that they managed to put in a retirement account, but they still had to figure out a way to sell down over time in a logical way. Products like this or programs like this really solve those problems for larger investors. And for smaller investors, I think there are going to be a lot of efficiencies in the corners that we're not really even looking at right now. Being able to manage precisely to your needs really does matter in the long term.
Yeah, you really have to have an opinion, though. Now, Patrick, you have a custom indexing platform you referenced earlier, Canvas, and this allows financial advisors to build individually tailored client portfolios in SMAs and separately managed accounts. Tell us how that works.
Yeah, so functionally, if you think about ETFs like the Model T, you can have any color you want as long as it's black. You know, you get sort of one size fits all. Canvas is sort of the opposite. It's very similar to going online and building a Tesla or something on their website where you get to sort of pick the rim color and pick the exterior, pick the interior. There are even more options than that in a custom index, but it feels like that. It's a very simple process, actually. A lot of the dimensions that we've already talked about, but you go through an online workflow and then you end up with a rule set, and then it's self-driving from there. A firm like ours or many others will come to the fore that do this as well. Think of it like self-driving money, right? Like you set the rule set, you set the conditions for yourself for your own personal index. And from that point forward, the firm manages the trading, whether that's tax loss harvesting, complying with some custom requests that you have, et cetera. But to the advisor and eventually to the end investor, it'll feel like just the next generation of any technology, just like using Stitch Fix for customized clothing, or like I said, building a Tesla online.
So I still want an example. Go ahead.
Yeah, so the other thing, too, is that it really doesn't get much more expensive. I think that's a critical component. You mentioned, like, our fees going to get out of hand. I suppose you could imagine a world where the spreads on the trading might hurt you, but the ETF has to play in that game too. The kinds of expense ratios we're talking about at the end of the day don't look much different than what we're seeing in the middle of the pack on the ETF market. Can you do it for 3 basis points? Not today. Can you do it for 20, 30, 40? Absolutely.
Yeah. So, Patrick, I want to go back with the example. I brought up the ESG as an example, but sure. Walk me through a portfolio. You run this Canvas platform, right? Well, what's popular strategies on the Canvas platform? Give us a little mental model about how you would, what typically the people are doing on that platform.
Yeah, sure. Maybe I'll give one that has sort of two components that are quite different from one another that were designed early in 2020 pre-pandemic. So this was a taxable account. It was one that it's one of the 20% that did care about ESG. So it was set to avoid companies with certain criteria, most specifically fossil fuel, carbon emission exposure, so to underweight companies with the worst offenses there, but also to generate as much after-tax benefit as possible, meaning when there was an opportunity to trade a position at a loss, do so that I can book that loss and use it to lower my tax bill elsewhere. Come the pandemic in March and April of 2020. And what you see is this very quick reaction of the custom index to sell those positions and generate a multiple percentage point after-tax pickup benefit while also managing something like the ESG exposure. So that's just 2 dimensions that were custom for that specific account. It was a broad market exposure. Think of it very similar to the S&P 500, just with these 2 key adjustments for this particular family. And again, we're seeing tons of different examples just like that one, but it allows you to react to changing market conditions versus just hold a simple exposure that can't generate things like tax benefits and customize to the person's circumstances.
So other than the 20% that are using it for ESG purposes, is there any generic other group of people that are using it for specific purposes? I mean, is most people taking an S&P 500 index fund, or are they using other indexes, and building customs around other kinds of indexes? Any trends that you're seeing? I'm trying to get a sense of what people are doing with all this.
So the beauty of a flexible platform is it's all over the map. So yes, some look kind of like the S&P 500. Others look like the MSCI ACWI, a world index. Others look like a 50-50 large cap, small cap, wanting to tilt more towards small cap. So you can use it to create a custom asset allocation at the high level if you want, and lots of people do that. At the more micro level, we also see a ton of risk management customization happening. So we already mentioned this idea of, let's say it's a Google executive or an Accenture executive that has a big stock position in that one company, and obviously their earnings associated with that company. We see tons of people adjusting for that in their portfolio, and we basically shrink away from similar companies. So, we own Google, own less Facebook too, and towards companies that are more complementary and different in their risk profile. So everyone's risk is a little bit different based on what they already own and what they do with their career. We can also adjust for that, and that's a third thing that we hadn't talked about yet, which is very popular.
Yeah. So Dave, if you're picking your own stocks and you're creating, the Bob ETF, what's the benchmark? How do I know how I'm doing, or is that a silly question?
Well,
I get confused.
I think the word index is in this for a reason, right? We've been managing separately managed accounts since the 50s, right? But the reason we call this direct indexing is you start with the idea that there's a piece of intellectual property that you want to follow. Call it the MSCI ACWI, right? That's thousands and thousands of stocks. You obviously don't need to own thousands and thousands of stocks individually, so you can use something like Canvas to winnow that down to just getting the actual real economic exposure with these twists on it. But then once that's set, it really is like an index. There's nobody picking and choosing stocks on a week-to-week basis. This isn't active management. It's software. That's really what we're doing. We're taking the same indexing software that's been used, say, at BlackRock forever to run their funds, and we're bringing that down to the individual account level. That's really what's happening. It's just bringing that massive software down to effectively an app on your phone.
Right. And Patrick, in the discussions I had with you, you wanted to make a difference between direct indexing and custom indexing. This is a little in the weeds, but you made this very clear. Direct indexing is you pick the index, whatever index that might be, the S&P 500, FTSE, whatever, and you run the tax law strategy with those holdings that you pick out of that index. The research portion for direct indexing is done essentially by the index providers. They have the index. Custom indexing uses in-house researching, essentially. You can target anything you want. If I want to target a 2.5% dividend yield, is that an important distinction, this difference between direct indexing and custom indexing?
I think it's really important, and that you'll see the leading firms go more towards the custom side than the direct side. And I would think about it in really simple terms. Does the firm doing this for you, us or somebody else, do they control the research or not? In the case of direct indexing, it's like you said, it's outsourced to S&P or Russell or MSCI, and those indexes are the baseline off of which you can then make little small tweaks. We think it makes much more sense to go from the bottom up, build exactly the strategy that the customer needs, and use in-house R&D to do that. That allows you to do a lot more small, granular, flexible things. It also allows you, I think, to just do a better job of moving quickly and accommodating new investor demands as they come out, not waiting for a third party to update their index methodology. And I would think about this just like ETFs. The vast majority of ETFs are not market cap weighted exposure. There are some index methodology that somebody somewhere designed and maintains and occasionally updates. We would rather that our investors not be at the whims of those research people and those designers, but rather control that in-house so that we can give customers exactly what they want.
Yeah, Dave, I want to switch topics a little because I want to get your thoughts on something that happened on Friday. The Senate Finance Committee on Friday proposed a raft of loophole closures around some of these systems and ETFs, and one very specifically targeted was the in-kind redemption tax treatment ETFs rely on. I've gotten some questions about this. Can you explain this simply? What is this about? How in-kind redemption tax treatment works, and how this would affect ETF owners if it passed?
Yeah, sure. If you're an ETF owner, generally you don't get any capital gains distribution from the fund company, because when money comes out of an ETF, the company can push out their lowest basis shares, the ones that there would be a taxable event on. That's part of the creation and redemption mechanism. It's been that way since 1993. It's not something that's brand new. It actually dates back into the 40s if you really trace it all the way back. There is a specific line in the Internal Revenue Code that says mutual funds and ETFs can do this. Senator Wyden in his proposal says, let's just cut that line out of the Internal Revenue Code. It's very simple. It's literally one sentence. But what it would do, it would mean that that window goes away. You can no longer redeem your low basis shares. So it puts an ETF and a traditional mutual fund pretty much on the same footing, which means if somebody has to sell inside the portfolio, there's a taxable event.
So if I owned a Vanguard tech ETF, fund, right now I pay almost no capital gains until I actually sell anything, of course. But if they eliminate this, it means you'll get a taxable gain distribution if they sold to meet any redemptions, just like a mutual fund.
Yeah, not only to meet redemptions, but also just rebalancing, right? I mean, almost all of these funds have some sort of rebalancing mechanism in them, except for, the most generic cap-weighted exposures. Every time that happens, it can theoretically create a taxable event, which you then have to pay for whether or not you did anything, whether you sold anything. So that's why we've always said ETFs are more tax fair, because you, as the investor, determine when to sell.
Yeah, and not to ask a silly question, but why are they doing this? Why are they trying to close this loophole? And what are the chances it's going to get enacted?
I think the chances are fairly low. It's easy to look at this and say, well, gosh, this is a thing that rich guys are taking advantage of. It's actually smaller investors that benefit the most from this. High net worth investors generally have lots of ways to shelter taxes. ETFs are convenient, but by no means the mainstream of how high net worth investors manage their tax situations. But if you're a smaller investor who's been accumulating some money outside of your 401k, ETFs have been a great boon. I think that this is pretty regressive, and for that reason, I think it's pretty unlikely to pass. But the reason, to try to raise revenue, obviously.
Okay, thank you very much, gentlemen. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Patrick and Dave for joining us today. And thank you for watching. I have asked Dave to stick around with me for the ETF Edge podcast portion and discuss his concerns about Gary Gensler and a Bitcoin ETF. Dave's turned very negative on the prospects for it. I want to get his thoughts on why. And remember, you can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.